The Indian rupee has slipped to around rupees 96 per US dollar, making it the weakest Asian currency in 2026. What's surprising is that this depreciation has happened despite the India's strong GDP growth of around 8%, suggesting deeper stress in India's external sector rather than domestic growth conditions. Let's understand how the rupee moved over the years. During independence, the rupee was fixed at rupees 4.76 per dollar under a control exchange system. This rate remained stable until 1966 when wars, drought, and falling foreign reserve forced India to devalue the currency. The oil shocks of the 1970s and the rising external debt pushed the rupee even lower. By 1990, it had fallen to around 17.5 per dollar. Then came the 1991 balance of payment crisis, a major turning point. Growth improved, but the rupee continued to depreciate, touching the around rupees 43 per dollar by the late 1990s. By 2014, the rupee was rupees 60 per dollar, and over the last decade, it slipped from around 62 to nearly 90, and now in 2026, it is around 96 per dollar. But why does the rupee keep losing value? India runs a chronic trade deficit because it relies heavily on imports like crude, gold, and electronics. That this keeps the demand for the dollar high, especially when the oil prices rises. India imports nearly 89% of its crude oil requirement from other countries, making the economy highly dependent on the global oil prices. In FY25 alone, India imported around 242 million tons of crude oil, with the import bill rising to nearly $161 billion. Global conflicts, especially in the Middle East, have pushed the oil prices higher, increasing pressure on the India's foreign exchange reserves. Since the crude oil payments are made in US dollars, Indian companies need more US currency, and that weakens the rupee further. A stronger US dollar, the high interest rate US interest rates, and foreign investors moving safer to safe US assets have added even more pressure. Apart from the crude oil, India also spends heavily on gold, edible oil, fertilizer. Reports suggest that India spent over to $40 billion on just three food imports in FY26. A falling rupee makes imports costly as fuels. Inflation widens the trade deficit and increases the debt service cost for companies and government. And that's why the rupee's decline is not just about currency, it's a serious concern for the broader Indian economy.